So welcome into the stocks I'm buying April 2023 edition, the UK version. So I'm going to go through the UK stocks that I've been buying from the 1st of March to the 1st of April, and I'll spend 3 or 4 minutes talking about why I bought these stocks. I can't commit a full 10-minute talk to each of these stocks just because the video ended up being over an hour long, and I don't think you guys would want to stick around for an hour watching me talk about these stocks. So I'll talk about them for 3 or 4 minutes so we get through them all nice and quickly. And as always, I think I've got a full video on most of these stocks on the YouTube channel somewhere if you do want a little bit more detail into them. But we'll get started. And as always, if you want to know what I'm buying and selling in real time, the place to be is on the Patreon. Join through the link in the description and you don't have to wait for the monthly update. Since the 1st of April, I have added another 3 new UK stocks into the portfolio. So if you don't know what them are, join through the link in the description. You also get 2 exclusive videos a week on the Patreon, and it's only £5 a month, which I think is pretty good value for what you pay for anyway. And also shout out if you want to get some free shares worth up to £100. Join Trading 2 and 2, the link in the description. Someone got a free share of Tesla yesterday. I think it was for like £65, so not bad at all. That's personally for me, the broker that I use. But we'll get stuck onto these stocks. So first of all, Celsius is not a UK stock, but there's a point to this somewhere. So I did sell out Celsius on my US holdings. I sold this for a 45% profit. I sold all my shares. I've been selling it for a while, but I completely sold the full position last month. Now, because I sold that position, it generated a lot of cash. So this is why this month there was a lot of stocks on the UK list, because I looked after I sold Celsius and I was seeing a lot of opportunity in the UK market. So I used a lot of the cash that I sold from the stock that I sold for profit to go buy a few UK stocks. So this is why you'll see there was a lot of stocks this month. Some of them were a little bit of some nibbles and some were bigger chunks. But this is why there was a lot of buys this month, because I sold Celsius for a lot of profit on my US holding, or my US portfolio, and then moved it to the UK because I think there's a lot of bargains out there in the UK market at the moment. So first of all, the first stock I used with some money that I made from Celsius was ASOS. So I wasn't really planning on buying ASOS, but because I had a lot of cash available, I thought, okay, I'll have a little bit of a nibble here. And I think there is still a few issues going around with ASOS, but I think they could potentially resolve them in the next 12 months, and this could be a very good opportunity. Now, obviously, in the share price point of view, this stock has been killed. Look at this. It's lower than where it was, I think, in 2008. Well, it's getting close to where it was in 2008. It's not actually lower than 2008, but it is lower than where it was in 2010. So it shows you it's been killed off. Absolutely huge. Now, ASOS is one of those companies that had a massive boom in the CV times, and since the CV times it's had a few issues where it's had so much demand pull forward. It's trying to sort out the demand. It had returns skyrocket, it had the inflationary pressures, it had the issues where shipping was taking forever. So there's been a few issues going around with ASOS, and it looks like potentially they could be resolving some of these issues from the CV boom that I had a few years ago. And that's why you look at the share price, it's had a lot of negativity priced in, and now I'm thinking at this sort of level and it goes back to growth and it holds a lot of the CV boom that it had and doesn't give too much of the revenue back, and it goes back to profitability or close to the old profitability it used to do, this could be a very good opportunity. Now, ASOS I think is a very safe company from the point of view that competition I don't think will affect it that much. The reason why is because if you go on ASOS, they basically sell all the brands you want to own. If I was to go on men's and let's say I wanted to pick some shoes, I could buy some ASOS shoes and its acquisition of Topman, and that is actually potentially why the gross margins or the profit margins could be a bit better going forward, because it has its own brands now. But they also cover a lot of the other big brands out there: New Balance, Crocs, Dr. Martens, Lacoste, Nike Running. If I just wanted some trainers, I could limit it down. I could go trainers and then I could search every brand out there. So if there's a popular brand, they're going to be on this ASOS site and they can just keep adding more brands in. I think this is why it'll always be a popular site, because it will always have the in-demand brands here. I just want to know, okay, maybe I want some white trainers. I search in white trainers and I get all the brands up and I can shop around it. That's perfect for me. I use ASOS myself because it gives me that option to have a look at many, rather than me having to go to all these sites individually, like New Balance, Nike, Crocs, even though I wouldn't actually go to Crocs to buy any shoes, but I could search across all these sites on one site, which I think is absolutely great. And adding the fact that you hope Topman improves the margins and having more of their own brands, I think this is a company that should be able to balance out any competitive threat. And like I was saying before, the actual financials look to be moving a bit more and back into a positive place. You can see here they're confident in the outlook that they gave in the recent trading update. Now there is one coming up on the 5th of May, which I'm kind of waiting for because I do want to see that they are resolving the revenue issue and the profit issue more and more. So I will be waiting for that, but that'll be the next time I buy once I see the more information from that. But you can see here that the revenue was only down 3%, and obviously that's the whole Ukraine situation and some other still effects going on here. So they're very much moving into a positive direction nearly with the revenue now. The gross margins were improving, as you can see here, and if we carry on seeing the company improving, I think this could be a good buy if they're able to get back to the previous rates that we're doing before the CV situation. Now, the only little thing that I have is they have had a management change recently, which is the only negative. I would like to see probably an experienced management team leading them through this period, and that's the only little thing that I don't like about it. But yeah, I think overall, I'm happy to buy in a few shares in ASOS. Next one was National Express, so I did take a nibble on National Express. I think that this company here is actually a company that's been doing amazing. I don't know why this company has been absolutely demolished on the share price. If we have a look at the share price here, you can see that from the CV situation, it was a stock that was performing quite well over the last few years, especially when you look at the run-up from 2018 to 2019 before the CV situation, as well as having a very nice dividend. And then it had the absolute drop in the CV situation. Obviously, in this time frame, this is when everything was coming towards the end. There was the peak fear out there. And the stock went all the way down to, that £1.33 range, £1.30 range. And now we're moving out of the CV situation, and this stock is still them sort of levels. And financially, the company's actually been performing really well, and it's actually brought back its dividend, which you can see here. You're picking up a 4.2% dividend yield. And like I said, when you look at the recent financials, everything is to like. The group revenue was up 24%, group EBITDA was up 31%, they brought back the dividend, they were winning major contracts, like they were securing a national rail contract in Germany that's worth $1 billion, because it's not just a UK coach company, this company provides transport around the world, and all around the world it was extending a lot of its contracts. And I was looking going, this company's financially absolutely smashing it, but yet the company's valued at even lower than the whole CV situation. It just totally don't make sense. And you're looking at all the situations like, why is it down here? You're thinking, well, is it the fuel costs? Well, fuel costs have come down and they're also hedged, so it's not that. The debt's fixed until 2024, so it's not really that. You're looking at the situation of like, is it to do with the strikes? Well, the people that are doing strikes have just accepted a pay increase, so it's not that either. So it just doesn't make sense why this stock is currently so low, but it is what it is at the moment. So yeah, I think this is a crazy opportunity. I think maybe it did have a drop in the last few days, but I think that was mainly due to the going ex-dividend. But yeah, I think this is crazy low at the moment, and financially been performing amazing as well, which doesn't make sense. The other one was Best of the Best, so I did have a little bit of a nibble in Best of the Best. I've had this stock for a while, and it's once again a company that got really affected because it had such a booming CV. It's then had a cooling off phase because it's had so much demand pull forward, and I think this has gone way too low for where it should be. It's obviously had a cooling off period, but now it's getting valued crazy low. So it's getting valued at 12 times earnings, 1% dividend yield at the moment. And the recent trading update was actually really good from Best of the Best. You can see here the revenue was down from where it was in 2021, but you can see here they're actually holding on to the profit from where they were in 2021. So even though they're making less revenue, the profit is still the same. And if you actually look at the EPS was actually, or earnings per share, it was above where it was in 2021. And you can see here all the revenue now is starting to normalize, and they should go back to good amounts of growth. And with the business model that Best of the Best have, which is like a spot the ball contest, they should be able to keep on using that platform, adding new competitions, maybe expanding internationally, which should be really good. And when they have a balance sheet as well, when they have the profit this company has and generates, as you can see here, even with the revenue slowed down, and you can see here on the financial health wise, it's an amazing balance sheet. There's no debt on there, and they do sit on quite a lot of cash for a company this sort of size. There's a lot of room for them to carry on using that cash to potentially buy back shares, which they have done, or increase the dividend. It's only 13% payout rate. So yeah, I did buy a little bit more Best of the Best. Next one was Catebox. So Catebox is a stock that I think is extremely low once again. If you look here, it had a bit of a run up into the start of the year. The stock was up massive amounts, and then it's given it all back since the start of the year for no real clear reason. Now, this trades at 10 times earnings. It pays a 6% dividend yield at the moment, and I am probably this is my last buy before we do get a trading update, because the last time we had a trading update was on the 14th of November. So I'd like to see how the company is doing financially and get a bit of an update. But yeah, I mean, last time we got one on the 14th of November, they had a bit of a tricky time in summer period where people were a bit slower going out and buying some cakes. There was obviously the summer holidays, there was the hot weather, so there was a little bit of a profit warning over the summertime. But since then, they've seen all the sales start to recover and the company's gone back to growing in the good way. The gross margins haven't been hit. The profit is down slightly because it has been reinvesting into some of its vehicle fleet that it was supposed to do before the CV situation, but that knocked it back. So I'm happy with the investment that it's making from that point of view. But you look at this company here thinking, well, you're getting it at 10 times earnings, a massive dividend yield. People are still going to go out and buy their cakes, and hopefully they carry on opening up new stores. Potentially they get more kiosks, which I'm a big fan of, and potentially they get more of a deal with some more supermarkets, which seems to be having good success rate. And it looks like a lot of room for the company to keep expanding. You look at the track record of the company, very good track record of delivering on profit and revenue. Financial health wise, you'll be able to see it's a very strong balance sheet, and they've got limited amount of debt there, 8% debt to equity, and they do sit on 5.7 million in cash. The dividend has a lot of room to potentially get hiked up, and also the insiders have been buying the company as well, which obviously is another positive inside the business. And if you do want to join this platform that I'm using in this video, which is Simple Wall Street, you can join through the link in the description. Join through there, you actually get 40% off, so give it a go, and a 14-day free trial as well, and you get to see what I'm showing you now of all the insiders buying, all the past performance and the financial health, and it's all very easy to use and get around the platform as well. So yeah, I did buy a little bit more of Cakebox. The next one was Flutter. Flutter has been performing really good, as you can see here. The stock is up in the last 6 months over 38%, and I did buy a little bit more Flutter into the portfolio. Now Flutter owns a lot of brands. You can see all the brands here from the likes of Paddy Power, Betfair, PokerStars, Tombola, and it's got that kind of UK market which is very mature. But the big reason why I bought Flutter is because of this brand right here, which is FanDuel. Now most of you guys will know that follow the channel that I'm a big fan of DraftKings, but the other company that has a big market share in the US and the growth of US online sports betting is Flutter, and between DraftKings and Flutter, they're probably going to control around 90% of the online gambling market. And I've already got good ownership in DraftKings, but I wanted to have a good stake in FanDuel, and to have that, I had to buy Flutter, and also because it has these profitable parts of the company. At the moment, FanDuel isn't growing as quick as what DraftKings are, but it has the more mature part of the platform that helps with the profitability. So they do generate a lot more closer to profitability than what DraftKings currently is. And in fact, they are forecasting for the US platform to hit profitability this year. So that is obviously really good. Now, because it has the more mature platforms, the growth doesn't look as good. But actually, when you do look at FanDuel, obviously it is growing at really good rates individually. But you've got the group revenue here, 27%. You've got the group EBITDA growing at 27%. And this company should generate a lot more profit from the US platform going forward. And also it's going to have a lot of growth because that FanDuel platform keeps getting bigger and bigger. This is going to be driving growth for it very much in the next few years and should continue to grow profit. And it should grow a lot faster than what it has done previously with this hot new US market that has come online. So I have picked up a few more shares into Flutter. And that was all of the stocks that I bought with the Celsius money that came up. These ones I bought individually, just take that into consideration. So there was Darktrace that I bought. Obviously you guys know I'm trying to get a cybersecurity stock. Looked at Darktrace for when you look at the company and what they're doing. If this was a US company, I reckon it would be double from where it is right now. I think it's been punished listing on the UK market. And also I wanted a cybersecurity company. I think this is going to be a massive space in the last year with cyber attacks happening more and more. I think you got Darktrace, which is undervalued and seems to have a very good product where a lot of people are using different products that it has, and also the churn's quite low in it, and I think the valuation, like I said, is pretty attractive. They recently came out with a trading update, which was on the 13th of April. I was quite happy with the trading update. Basically, they've not seen anything too much change inside the business. And everything they gave on the last trading update basically happened, where they're still seeing good growth in the company, but they're seeing a lack of new customers coming on, probably because of the recession fears, cutting budgets, and companies not willing to spend so much with the environment that we're in. But that should resolve itself going forward, because as more and more of these cyber attacks start happening, companies will spend more and more on this area, and Darktrace should capitalize from it. Now, Darktrace itself is currently around about break even, but actually from a free cash flow, it is free cash flow positive, and actually works out as a pretty good free cash flow to market cap for what you're picking up with the growth that the company offers at the moment, and they have a very good track record. Financial health wise as well, there's no debt on the balance sheet, and they do sit on a really healthy 380 million cash for a 1.7 billion market cap, and that actually has led them to be buying quite a few shares at the moment back, which is obviously positive. And there was also a big buy from the CEO and in February, which was around about 108,000, which is really positive as well. So that's obviously a positive sign. The next one was Airtel Africa. So I actually think this is probably the best opportunity right now on the UK market. It's a 7 times earnings, 4% dividend yield at the moment. And this company is basically capitalizing on the market in Africa where there is a lot of mobile phone usage and the growth of 4G. 4G is getting massive in Africa at the moment because there's not really the developed Wi-Fi system that a lot of Western countries have. So a lot of people in Africa use 4G networks, and then obviously there's a 5G ramp up afterwards. So they're capitalizing from that, and they have a mobile money app as well, which is also doing really well because the banking system once again isn't as developed as what we have currently in, say, the West side of the world. So the digital banking space is growing massively. They've got a digital banking platform as well, which has been growing huge at the moment, and that's very clear when you look at the past performance of the company. Look at the rapid amounts of revenue and profit growth going on, and like I said, 7 times earnings, and you're getting nearly a 5% dividend yield for this, and this should continue growing going forward as well. Financial health wise, it has improved massively as well. This was one of my concerns when I first invested, but they've actually solved this pretty well. It's around 50% debt to equity at the moment, so I'm a big fan of that. So I think when you look at the growth you're getting for this company, 7 times earnings, 4% dividend yield, I think this is definitely an attractive valuation right now, and I do like this opportunity. And we're on to the second last one, which is Legal & General. Basically, this is my boring stock. It's a very, very safe stock. People are going to carry on using the Legal & General products they have, the likes of pensions, life insurances, and it's a very steady buy a stock, and it should just pay you a nice dividend. Trades at 6 times earnings. It is always going to be a low earnings stock, but I still think that is a little bit low for what Legal & General normally does trade at, and you're picking up a 7% dividend yield at the moment. And looking at the track record of the dividend, it should continue to get hiked up going forward. So this is very much a buy. I'm not expecting too much from the share price. I do expect I'll probably get some appreciation, but I think when you look at that dividend yield that you probably will get, you're basically getting the average return what the S&P returns you every year in a dividend, which I think is probably going to still continue going forward because they are still generating good amounts of earnings at the moment. And I think this is a very boring safe stock for me just to hold, and especially when this stock had a dip out of nowhere. If we actually just have a look in March, so you can see here in March, this is where we had the dip in Legal & General stock, and I thought, okay, I actually think I bought at 2 different points here, so I thought I'm going to buy some shares down here, and that's what I did. And since then there has been a bit of recovery in the stock, so I did take that opportunity there. And that leads us on to the last stock on this list, which is a growth stock, my favourite UK growth stock, which is S4 Capital. So this had a bit of a tough time recently. The share price has been moving down since February, and there's no clear reason why it's been moving down. They did bring out a trading update. The trading update was on the 29th of March, so the share price was actually dipping before this time frame. They brought out this trading update, and it hasn't really helped the share price stop its decline. But once again, we got very good information. I don't know why the share price is being held back at the moment. Maybe it's just the uncertainty that we're in the environment where there could potentially be a recession, and people are feeling, okay, this is a marketing company is going to get killed in the recession. But yet all the way through the last few months, we've seen them still do very well and outperform the industry in this downturn, which is great. Full year net revenue like flight growth of 26%, and you'll actually see revenue was 55% year over year, and you'll able to see that operational EBITDA was 124 million, and the revenue was slightly ahead of guidance, by the way, and operational EBITDA was slightly ahead of guidance once again, and that solved one of the things that the company only did wrong really, is they overhired, and that did hit the EBITDA in the start of 2022. That does seem to be resolved now, and also a very strong balance sheet, and the guidance they offered once again was pretty decent. So I'm looking at this company here going, if this was a company that was listed on the US market, a US company that was doing this sort of growth that S4 Capital currently is and offering at the moment, would be a massive premium company. You wouldn't have a company that would be trading at these sort of levels. So yeah, I think that this company is massively undervalued and maybe just getting valued at these sort of levels at the moment just because we're in a fear of the recession and it's a marketing company and people think it's going to continue to get hit, even though it's not really showing much impact of getting hit at the moment, but that it could get hit if things do get worse with it being a marketing company. So yeah, I think this is a good opportunity. Now I was buying a few more shares in S4 Capital, so hope you enjoyed the video. Like I said earlier, I briefly went through all the companies in 2 or 3 minutes just because if I spend 10 minutes on every company the video ends up being too long, but I think I have got a full video on all these companies somewhere on my YouTube channel if you do want me to break it down into more detail. But yeah, hope you enjoyed the video. Let me know if there's any of these stocks that you're buying or any UK stocks that you've been buying recently as well, and as always, smash the like button if you're new around here, subscribe, and I'll catch you in a bit.